that 2008, I think, was the Great Reset. The one that people keep expecting happened. Well, most people tend to err towards well, it's all going to blow up. I'm like, show me how. If you can debase a currency, a global reserve currency, how's the assets going to collapse? You can't. It's like the Venezuelan stock market goes a lot in Bolivar terms. In dollar terms, it goes down.
Right.
That's debasement. So I'm like, I don't think that is the outcome. What I actually think of the outcome is, remember that magic formula, GDP growth plus productivity growth plus debt growth. Right, debt growth is stopped. It's just servicing of old debts. Population growth, we know, is negative out for 30 years. And what is the answer? AI and robots. They're infinite humans.
After months of steadfastly maintaining a hawkish stance despite signs that the economy was cooling too quickly, Federal Reserve Chair Jerome Powell has finally delivered the strongest dovish signal since the U.S. Federal Reserve began raising rates in 2022. Speaking at the Fed's annual Jackson Hole Symposium in Wyoming on Friday, Powell indicated that the central bank plans to start reducing the historically high interest rates in September. The time has come for policy to adjust, Powell stated, adding that the direction is clear, but the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. While Powell did not specify how much the Fed would lower its key rate next month, most forecasters anticipate a quarter-point reduction in September, with at least one more cut expected before the year ends. During his speech, Powell acknowledged that while the Fed's task of reducing inflation is not yet complete, significant progress has been made. He expressed confidence that inflation is now on a sustainable path back to the Fed's 2% target. Additionally, Powell highlighted the state of the labor market as a key factor supporting the decision to cut rates in September, noting that upside risks to inflation have diminished, while downside risks to employment have increased. He emphasized that it is unlikely the labor market will drive elevated inflation pressures in the near future and stated, "We do not seek or welcome further cooling in labor market conditions." This shift is a moment that several analysts and prominent investors had consistently predicted over the past few months, despite the Fed's earlier insistence on keeping rates higher for longer until reaching its 2% inflation target. Among those who accurately foresaw this development is Real Vision founder and CEO Raoul, who has spent much of the year educating investors about the everything code and explaining why the Fed and other central banks are almost certain to resume rate cuts and quantitative easing. The rate cuts, QE, and their impact on asset prices, particularly cryptocurrencies, are central to Powell's everything code thesis, which he recently discussed with Mark Moss. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
What's weird about the everything code, and I'll explain what it is. What's weird is it makes everything so simple.
Too simple.
That most people think, well, this can't be possible.
Yeah.
We kind of knew it in Bitcoin world because we could see a cycle forming, and we've been following this cycle kind of dumbly, like, well, it's kind of maybe just the halving cycle. We don't really know. And then I started digging in and realized that the business cycle was perfect. So the business cycle, I used the ISM survey, and it was a perfect cycle. I'm like, that's weird, because if you remember, go back prior to 2008, we'd have these long periods of no recession, short periods, and it was variable. But suddenly it's like a metronome, as you say. I'm like, what's that all about? And eventually it led me to realize that 2008, I think, was the Great Reset. The one that people keep expecting happened. What they did is they basically they told everybody they could forego paying interest on all their debts, which was zero interest rates. And then they tried the new trick of printing money via quantitative easing. Now, what that did is allow every single major government in the world to refinance all of their debts on this 3 to 5 year sector. And so they all did it. And what it did was force the business cycle into this 4-year cycle. And then all the asset prices are all correlated. Whether it's tech, whether it's Bitcoin, whether it's the economy itself, it's all driven by the same cycle, which happens to be the presidential election cycle, which happens to be the Bitcoin halving cycle. It's all the same thing. And so when you understand that, it makes the game a lot easier. Now, this is not going to last forever. But for the period of time that we've got, it seems to be playing out perfectly. And you can break these cycles down to 4 phases, which I call the seasons. So we have, call it crypto or macro winter. Well, that was 2022. That was 2018. That was 2014. That is 4 years. The next part of that is spring, when nobody quite believes that something is changing, but prices start moving higher. You know, Bitcoin had a great year in 2023 against most people's expectations, because spring is the time the shoots come up. Then you start transitioning into summer, which is this year, which happens to be the election year, which is when really the debt starts getting refinanced and they have to start using liquidity to finance it, because there's not enough GDP growth to pay for the interest on the debts. And so they keep rolling forwards these debts and they keep monetizing the interest payments, which is this debasement of currency that happens at about, on a globalized level, 8% a year. They're debasing currency. And then next year will be macro fall, and then eventually the cycle tops out and we repeat it again because it's based on the debt refi cycle.
Right.
That this debasement of currency of 8%, there's two ways of looking at it. You can say, rightly so, we're being robbed of our future wealth because your future self is getting poorer because you can afford less assets with your income, because income doesn't go up, the assets do because of the debasement. Or the other way is you can say, I'm paying an 8% put option fee on the entire system not breaking, because that's also what they're doing. Because they need to refinance the debt. They need to not let asset prices go too far down. So we can talk about that, but it's another way of looking at it. And you're like, would you pay 8% a year to have the entire system not break? Maybe.
According to Raoul, central banks have discovered a magic formula to stave off the global economic collapse that many have predicted for years. However, this strategy comes at the cost of debasing fiat currencies. Powell believes this is a small price to pay to avoid a global economic meltdown. The renowned macro analyst argues that the best way to navigate this environment is by investing in assets that are likely to outperform during periods of currency debasement. In his view, nothing compares to cryptocurrencies, particularly top assets like Bitcoin, Ethereum, and Solana. Powell is forecasting at least a 400% increase in the overall cryptocurrency market cap by 2025, predicting it will rise from just over $2 trillion today to between $10 and $15 trillion at the peak of the bull market next year. For the broader global economy, Powell suggests that central banks will be able to maintain stability by periodically printing money until a more permanent solution emerges. Here are more clips from his discussion with Mark Moss.
If you think about an aging population, if you think about your parents, the older they get, the less they spend. So aging populations tend to have lower trend rates of GDP. They all do. It's happened, observable everywhere, because old populations spend less. They also tend to not know how long they're going to live for after they retire. So when my dad retired, his spending must have fallen 60 or 70%, because he's like, well, I've got this much money, I don't know how I'm going to live for, is my wife going to be taken care of? And so they change their habits. And so that drags down GDP growth, as does debt. And so it keeps compounding this whole thing. Is right now, for example, interest rates are at 5.5%, but trend rate of GDP over the last 5-6 years is about 1.75%. So you've got this big gap and you need to get interest rates down so you can refi them, but all the time GDP keeps falling over time. And you can forecast it into the future. It's just the births, deaths, and it gives you 30 years of understanding. And it's just telling us, unless something dramatic changes, which is technology, we're just going to keep dragging down GDP forever. And we're seeing it worse. Older populations, Japan, China, most of Europe, they're older than the US because they had less immigration. What you find is their GDP keeps shrinking. Australia, on the other hand, has a high immigration rate, as has Canada, and they've tended to do better because of the immigration rate. Because really, GDP growth is driven by population growth, productivity growth, and debt growth. Well, most people tend to err towards well, it's all going to blow up. I'm like, show me how. If you can debase a currency, a global reserve currency, how's the assets going to collapse? You can't. It's like the Venezuelan stock market goes a lot in Bolivar terms. In dollar terms, it goes down.
Right.
That's debasement. So I'm like, I don't think that is the outcome. What I actually think of the outcome is, remember that magic formula, GDP growth plus productivity growth plus debt growth. Right, debt growth is stopped. It's just servicing of old debts. Population growth, we know, is negative out for 30 years. And what is the answer? AI and robots. They're infinite humans. And productivity, what is productivity? Productivity really is how much output per kilojoule of energy. Now, think of that as electricity costs. If you then think about, and a lot of people are like, the Europeans, they're nuts, look what they're doing with this green energy, they're wasting money. They're not. Their entire job is to lower the cost of electricity, because that is the only way they can pick up GDP, because it creates the multiplier to productivity. They don't have the tech industry in the same way, but they have, them and China are the big pushers of renewables. So the cost of renewables has been collapsing over time. It's down 99% over the last 15 years. So as it's getting cheaper and cheaper, eventually you can scale it enough that you will change productivity. On the other hand, you've got Japan, China, the US using AI and robotics, which creates infinite people. Now, if you've got infinite people, you kind of break GDP. I call it the economic singularity. You get to some point where GDP doesn't mean anything anymore. What does any of this mean? So if you've got productivity going up because of energy costs, and you've got infinite humans, or what, humans in inverted commas, then that changes.
According to Raoul, there's still a strong possibility of avoiding severe economic fallout, especially in countries with robust currencies like the US. However, he emphasizes that investing is essential for anyone looking to preserve and grow their wealth over time. Traditional assets like bonds may struggle to keep up with inflation, and while popular stock indexes like the S&P 500 can help maintain wealth, they might not significantly increase it. Powell recommends cryptocurrencies and technology stocks as the best options, as they are likely to continue outpacing currency debasement. What are your thoughts on the video? Do you agree that AI and other rapidly advancing technologies could be the key to addressing the world's massive debt challenges? We'd love to hear your opinions in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.